Well, why don't we get started? So hopefully some of you have been able to attend our legacy client seminars. We restarted those last year. We've done those for a number of years. We stopped during COVID and we love doing those. We've been doing webinars since then, and hopefully we're planning on doing those live seminars again this year. So we continue to plan on doing those. So hopefully you'll be attending. Well, we're nearly a month into 2023, and quite frankly, some of the obstacles from last year are just going to continue for some time. We've got inflation, we've got the war in the Ukraine, we have sharply higher interest rates, we've got a recent bankruptcy of the cryptocurrency exchange FTX, midterm elections. Quite frankly, there's a number of things that have shaken the market, and they're continuing to do so. So today we're going to dive into these topics more as we actually share our views on not only what has happened, but more importantly, what we're doing about it in your portfolios. For those that I haven't met, my name is Jim Herbst. Yeah, that's not the most recent photo. I'm a financial consultant at Manning & Napier, and I'm actually excited to be joined by one of our veterans, Chris Petrosino. He's, well, I guess you can match the photos. He's been with the firm over 20 years. He's a chartered financial analyst, director of our investment policy group. And really what that means is he's responsible for setting the firm's overview on broad global macroeconomic outlook as it relates to stocks, bonds, and really our overall asset allocation decisions. Additionally, he's the managing director of Quantitative Strategies Group, which oversees our exchange traded funds. You're probably familiar with ETF-based solutions, as well as our disciplined value equity objective, which happens to tend to focus on quality and yield, sort of a dividend investment for clients. So welcome, Chris.
Thank you. Great to join this afternoon.
Also joining our webinar is one of our senior relationship managers, Megan Wright. Megan holds a designation as a certified financial planner, working with our financial consultants like me. And Megan actually brings nearly a decade of investing and wealth planning of expertise to Manning. So welcome, Megan.
Thanks, Jim.
So we're going to shift to the agenda. And today we're gonna do as follows. First, we're going to look back on 2022. Not that it's a year that we want to spend a lot of time on. It wasn't a terrific year. But quite frankly, it's shaped how we've invested the portfolio today and how we're looking at things going forward in 2023. Then, I think more importantly, we want to share how we implement our overview into an action plan, not only in our investment strategies, but really in our planning techniques and strategies. After that, generally, one of the best parts of these webinars is our Q&A session. So we've been getting questions for the last 2 weeks. We've got a pretty long list of submitted questions. A lot of them are fairly similar. So we're going to run through those at the very end. And then Megan is going to take on some live questions. So with that, we really do encourage you to ask additional questions as we go through our prepared comments today. You just have to click on the Q&A screen, and Megan's even more qualified than I am to pull that stuff up. It's not that I can't do it, but she'll do a better job at it. So we're going to answer as many questions as possible. We don't want people to start dropping off, so we want to keep everybody engaged, but we're sensitive to your time. But I assure you that we know exactly who's asking the questions, and we will get back to you, if not today during the webinar, we will get back to you relatively soon. So with that, Chris, why don't you get us started?
All right, absolutely. So as Jim mentioned, we want to start with just a brief reflection on the dominant story of last year and sort of how we see that evolving as we move into 2023. And you don't have to do too much perusing of the financial press year in review type stuff to know that really the big story last year was inflation and interest rates. And we had a period following the reopening as the pandemic faded, where inflation went from being a transitory phenomena to an increasingly entrenched element spilling into all corners of everyday life. And by the early months of 2022, it finally, I think, became clear that the Federal Reserve had an inflation problem on their hands, and they responded with great force. One of the most substantial rate hike campaigns that we've seen since at least the early 1980s. And so against that, we created not only a very challenging backdrop for fixed income, as bonds incorporated the prospect of higher inflation and what that would mean. But similarly, stocks also suffered. And the chart that we start with really looks at why did stocks fall last year? And we think about the math of stock market returns. There's three drivers. There's the dividends that the stocks pay us, return of capital to investors. There is the profitability, the earnings growth, and then the final lever or driver is the change in valuation. Is this a year where investors are willing to pay more or less per dollar of earnings? And what we saw last year was not a growth problem for the market. Market grew mid single digits in terms of earnings per share. The problem was in that the multiple, the valuation. And so as interest rates moved higher, investors started to have more alternatives for their investment dollars, and that combined with an equity market that, if you followed us for any length of time, we were warning heading into last year that valuations were quite stretched. So high valuations combined with more attractive alternatives elsewhere led to this compression in the multiple that we saw, and that really explained a lot of what happened last year. But as we look out to 2023, we think that the inflation story, the rising rate story, really was really is in our rearview mirror. And while in some respects that's good, particularly for fixed income, we don't think we're out of the woods yet for risky assets and for stocks in particular. And so what we're increasingly concerned about now is the impact of that dramatic increase in policy rates, both domestically as well as in many countries around the world. So if we go to the next slide here, what we have here is the year-over-year change in the index of leading economic indicators for the U.S. And this is a composite index. It's made up of 10 indicators, including things like housing permits, manufacturing hours worked, ISM survey of manufacturing activity, all these measures that tend to be more forward-looking in the economy. And so the big takeaway here is that, as of the latest data point that we have, we're seeing these leading indicators contracting at nearly a 5% year-over-year basis. And if we go back in time, here we go back to 1990, but the same holds true if you go back to the 60s when the data starts. Generally, when we get below 2.5% year-over-year decline in the leading indicators, one of those gray bars shows up, and those gray bars are recessions in the U.S. And so, we think that the increase in interest rates historically has always acted with a lag. We think it acts with a lag again as the price of money has gone up. We have seen a chilling impact in areas like housing, where housing permits have fallen substantially. Activity for demand is in turnover has slowed as interest rates have really taken a bite out of housing affordability. And so, as we look forward, we see those types of issues spreading more broadly in the economy. And it's also starting to show up in terms of business layoff announcements. So a number of technology companies have made headlines over the past few months, but we're starting to see it migrate more broadly into the rest of the economy. Just this morning, for example, 3M announced plans to lay off 2,000 plus workers. So, very much more old economy, industrial bellwether, showing some signs of slowing too. So, when we think about what does this mean for the market that's going forward, we think slowing growth now will start to sharpen investors' focus on that earnings growth that we had in that table before. So earnings growth was positive last year, and right now consensus, the sum total of all the Wall Street banks, as they look at the companies in the S&P 500, they're still expecting mid-single digit growth again for 2023. If we go back and look at prior recessions in time, what we usually see is it's not uncommon for earnings to decline by 10, 15, even 20%. So we think there's a pretty big disconnect right now between growth expectations and what potentially could happen. So that is influencing our thinking. And so if we go to the next chart here, thinking about the Fed and policy rates, one important thing that we look at, or axiom that we follow, is the idea of not wanting to fight the Fed. If the Fed is in an environment where they are increasing interest rates, sort of the proverbial taking away of the punch bowl, that is an environment that tends to be difficult for stocks and other risky investments. And so, not coincidentally, as we saw the rate hikes start to come in last year in our multi-asset class portfolios, we were decreasing exposure to stocks, and this was very much an organic process as we saw companies hitting sell prices and trim prices for us, and just against what was, we thought, though, and increasingly likely to be a challenging backdrop. The other part, though, is making sure that when we think about our investment game plan going forward, we also don't want, we want to be mindful of the fact that typically we don't see bear market bottoms until the Fed starts to go in the other direction and ease monetary conditions. And so we capture that here with a nice long chart of the Fed funds rate over time in the light green line, and those black vertical columns just represent the various bear market bottoms or troughs over the past 50 or so years. And what the main takeaway here is that those bars have historically only showed up after we've seen one or more downtick in the Fed funds rate, which is to say that we've seen pain in the economy. We've seen a material slowing such that the policymakers have to respond on the other side and start to ease conditions. So while there's certainly talk today of the idea of a Fed pivot or a slowing down of the pace of rate hikes, there's a difference between still having your foot on the brake, just maybe a little pressing a little less hard, than outright putting the foot on the accelerator. And we think that as we're looking at potential signs that would have us want to start increasing equity exposure, it's premature. And from our perspective, to really think otherwise at this point is to believe that this environment is different, that this is an environment where, despite those slowing of the leading indicators, we don't get a recession, or despite the fact that we have seen such an aggressive elevation in the Fed's funds rate and in policy rates around the world, we don't get a recession. And that brings us to one of my favorite financial quotes from the great investor Sir John Templeton, which is the four most expensive words in the English language are "this time it's different." And in my work on our quantitative strategies group, I spend a lot of time going back and looking at history and looking at what are some of the common markers that tend to occur around major turning points in markets and in economies. And while they're not always the same, they're generally very similar. So when we look at the sum total of the signals that we're seeing today, both from a top down, so these macroeconomic signals, as well as what we're seeing from the bottom up, which is to say our analysts on our sector teams that are looking across our investment universe, one by one for recommendations, we really feel like there is this is an environment where we do want to be cautious. We want to be very selective in what we've done, and that actually manifests if we look at the next slide, where we capture where our portfolios have been over the past several years. And this is the allocation to stocks within our long-term growth portfolio. For those in our balanced portfolios, this will be directionally representative of what is going on, everything from a growth with reduced volatility to our equity-focused blend portfolio. But what's key here is the direction, and what we can see looking at this this chart is after a period through 2020, 21 of really increasing stocks and being able to take more risk in the portfolio, as we saw opportunities that met our investment strategies and in pricing, that equity allocation started to wane. And by 2022, we'd gotten back to the midpoint of our policy range, which is 55%. These portfolios can be as high as 80, as low as 30. So we got below the midpoint and continued directionally to move lower after that, as we just found fewer and fewer opportunities, and also at a time when even before stocks started to turn lower, that valuations just weren't compelling. So we saw just these very organic signals from our analysts in the stocks they were covering and the recommendations they were making, and lining up, I think, quite well with the signals that we were seeing from the top down of the macroeconomic perspective. If we hop to the next one, though, it is important to note there are still many stocks in the portfolio today. We still have over 45% of, for example, long-term growth exposed to equities, and so that is a function of continuing to find opportunities in themes that we think, while most businesses are going to be economically sensitive, we're looking for opportunities in those areas that are a bit less sensitive to the broader cycle, and also have the opportunity to benefit from, in some cases, more secular drivers of growth or opportunity. And certainly these, particularly areas like the software as a service or cloud computing, or some of the things in biotechnology, these are themes that we've talked about for a long time, and they still remain very valid today. Although as the themes have evolved, certainly the players, those underlying stocks have changed based on both fundamentals and valuation. We continue to see these as areas of opportunity today. Additionally, call out the consumer packaged goods as an area that, again, in downturns tends to hold up a bit better, as that represents one of the more non-discretionary areas of consumers' budget. That's not to say these are the only areas that we're finding opportunities. And some of our equity focused or equity only accounts, in a couple of examples. One, in some of our non-US portfolios, there's a reinsurer, Renaissance Re, that we had recently bought with exposure to some of the major cycles that are unfolding in insurance, where we've had a period of extreme pain for property and casualty insurers, and generally there is a well-pronounced cycle that after periods of extreme pain, these insurers seek to recoup losses with more firm pricing, more aggressive price hikes and things like that. So finding opportunities there. And then on the US side, as concerns of slower growth, potentially recession, have started to unfold, while the broad market largely is not reflecting those concerns and earnings expectations. Certain corners of the market, particularly the ratings agencies, S&P Global and Moody's, that are quite exposed to changes in fixed income issuance, the pullbacks in some of those have given us opportunities to add in our equity portfolios late 2020, 2022. So just as a representative of some of the things that are going on. And so as we look forward, in terms of themes, we think there's likely going to be a time to start adding two more cyclical industries in the portfolio and looking for beneficiaries of some emerging trends. One, for example, is if COVID taught us anything, it's that as we look at our supply chains, we've probably run them far too thin, far too optimized. And instead of strictly just in time, the phrase I've latched onto, heard elsewhere, is the idea of just in case. And so as we start to build redundancies into the supply chain, great example of some of the new semiconductor microchip plants we're building throughout the country in different areas, those are going to produce opportunities. But we think, given the cyclical outlook, it is premature to be piling into those areas today. But they're very much on our radar screen. So talk almost exclusively stocks, but certainly in our balanced portfolios, fixed income factors largely too. And while last year was certainly painful, regardless of where you were in the fixed income universe, as we look forward, the resetting of rates has really, created an environment where, interest rates can actually do some of the heavy lifting in an investor's portfolio, in a balanced portfolio, both as a source of income now, as yields are hovering for, and then as we get into some of the riskier corners, even higher. But we're getting interest rates of interest, as we say here, from a return perspective. But we also think, as the market shifts and starts to focus on growth concerns, we are likely to benefit from having some interest rate sensitivity, some duration in the portfolio, because when growth concerns emerge, when growth fades, inflation tends to fade with it, and as that happens, we get falling bond yields, which boost bond prices. And so, our expectation is we will see bonds in this environment hopefully provide more of a ballast to portfolios than they did last year, when inflation was the concern. So, I will conclude with one final slide, and the outlook is based on this idea of this time it's not different. And the bad news with that is, we're likely to see additional pain, additional volatility as the market comes to grips with this with our base case scenario, should it play out. And believe me, we are actively looking for where could we be wrong. But right now, we think this is this is our base case. So there is likely going to be additional pain ahead on stocks, but it also unlocks opportunities, and that's what we tried to capture here on this exhibit, looking at every recession going back to the late 1940s and the associated peak to trough stock market decline that unfolded with it. And certainly a lot of red, some not insignificant numbers there, down 20s, down 30s, but I think what's equally important, equally encouraging, particularly because of our approach, which enables us to actively increase exposure to areas of the market as they become more attractive, we believe we can be in a position to benefit from what happens after, which is those very substantial green numbers that show up in terms of the market return coming out of the recession. And really, when we think back, it's I think worth noting that we have been doing this for the better part of half of the page here, in terms of the these recessions that we've identified. And I think it's important in this environment to have a manager with that type of experience that has been through these things, and that I think is it's important. Again, that idea of this time it's not different.
Thanks, Chris. So let me elaborate a little further on having a longer term perspective. Now, normally compliance would give us a flag when we're showing a 2-year track record, but this is actually a really important page, and let me tell you why. Actually, the time period of this performance of some of our investment objectives go back to January of 2020, and actually to conclude in December 31st of 2022. So first of all, when things are outside of your control as an investor, it's important to keep things in perspective so you don't fall into a trap. Because quite frankly, environments do matter. They're not always obvious. And what I mean by that is if you would have invested your account aggressively on January 1st of 2020, it was literally the peak of the market, and pulled your money out in about mid-May of 2020, that was about the bottom of the COVID first bubble we had. So what's interesting is more people would put their money in good times and pull out in bad. So that's important to point out. First and foremost, look at things in a market cycle. Secondly, as bad as 2022 was for our clients, and we don't underestimate it in any way, it wiped out primarily the gains from 2021. What we're looking at is a 2-year track record. So you did not lose 15 to 20% of your initial investment, or I should say 15 to 20% of your principal, which I think is important to keep in perspective. And let's face it, markets do reward long-term patient investors, as tough as it is. So as we manage this way, as we manage our way through these difficult markets, there's some planning techniques. And Megan is going to cover some of the strategies that you can benefit from actually this current environment we're in. So Megan?
Thanks, Jim. Chris highlighted what's going on in the market and the economy, and everything that you as a client and us as advisors can't necessarily control, but there are things that you and your advisor can control. And that's where planning comes in. And given that it's the beginning of a new year, it's always a good time to start considering your different planning opportunities. As many of the current clients on the call may be familiar with some of the financial planning services that we currently offer and the outputs that they receive from those. We've recently implemented a new program that is a new software that allows both you, the client, as well as the advisors to make real-time changes and updates to your plan. This software also has the ability to run a handful of different scenarios, including a Monte Carlo analysis of thousands of different possible scenarios as it relates to your financial plan to determine the probability of you achieving those goals. By running these different scenarios, you can determine what your plan needs and the risks you're willing to take on. And once that's done, you can work with your advisor to make adjustments as necessary to increase the likelihood of achieving your financial goals. We typically do encourage you to stress test your plan at some point throughout the year, or if you've had any personal life changes or financial changes. So for example, a marriage, a divorce, a job change, retirement, the sale of your business, all of those things would trigger a life event that would make you want to reevaluate and make sure that you're still on the same track to succeeding with your financial goals. To that end, a financial plan is not something you set and forget. It's a living, breathing document, and there are always planning opportunities to consider. Listed here are just a few of many different planning opportunities and action items that are available to you, especially items that you can take advantage of during a difficult market. For example, historically, as fiduciaries, it's our responsibility to take taxes into consideration when managing your portfolio. Last year, we were able to take advantage of a unique market environment and implement tax loss selling in the fixed income space across many of our multi-asset class portfolios, which is something that we typically only do with equities. So it was a unique opportunity that we had available to us that we took advantage of. Given the difficult market that we've experienced and continue to experience, many people may have additional cash on the sidelines that you've been waiting to deploy or hesitant to deploy. Staying the course is important. And as long as your investment objectives are still in line with your goals, so is continuing to contribute to your portfolio. You're essentially buying securities right now on a discount. So as long as you have the cash available and the opportunities available to you, it's best to continue to contribute to your portfolio. Of course, there's always tax-related rules and legislation that's changing, so staying up to date on that is always important as well. Which actually brings me to our next webinar that we are hosting on February 16th. This is our tax updates and planning consideration webinar. We'll be covering everything that I've just talked about in much more detail, also, along with notable changes such as the Secure Act 2.0 that includes RMD age changes, retirement plan rule changes, Social Security benefits, and much more. So make sure you keep an eye out on your email for an invitation to join that webinar. And as always, even if you can't attend, make sure you sign up because we do make the replay available to you after the fact. In addition to the webinar that I just mentioned, we are always publishing our annual planning guides, and those 2023 planning guides will be available within the next few weeks, along with our more robust tax and wealth planning guide and other resources listed here. We produce fresh insights throughout the year to keep you informed and empowered to achieve your goals. Whether you're looking to refresh your estate plan or talking to your kids or grandkids about your finances, we have something for everyone. And as you know, good investments and financial plans are just two pieces of the entire wealth management puzzle. Tax management and estate planning are often overlooked when establishing the initial financial plan. Tax planning is more than just a few weeks in April. It focuses on utilizing strategies such as tax loss harvesting, charitable donations, Roth conversions to fine-tune your tax situation throughout the year as well as long-term. Estate planning may not be an exciting topic, but it's necessary to defend what you've earned. Probate complexities and periodic changes to trust and estate laws are important to keep up with. And it's important that you work with a specialist who can ensure your assets are in full alignment with your wishes. At the end of the day, your success is our success, and we believe in utilizing a team of experts and utilizing strategies available to make sure each piece of comprehensive plan plays a key role. Alignment matters, and it's our job to make sure that all of the pieces of your financial health are working together.
Good. There we go. That's why I don't handle the live questions. Thanks, Megan. Thanks, Chris. This does conclude the formal part of our presentation today. What we do want to do now is go through our question and answer session. We've received quite a few. Interestingly enough, a lot of them have to do with very similar questions. So we are able to combine them. It looks like we've got some questions coming over the line, so we're going to touch on those as well. We've got a few pages that I think we need to cover from a compliance standpoint. I think Megan should be disclosure page. Yeah. Okay, this is good stuff. Important to cover. Just making sure that everyone knows that our performance is AMR compliant and audited. All kinds of important footnotes in here. So with that, I'm going to start out with the first prepared question, which does have to do with the Secure Act. And I think a number of you are curious about, and Megan, this is for you. So I'm just going to read it best I can. How are you advising your clients to deal with the extension of the mandatory required minimum distribution age to 73? Should they delay? Should they start at 72? Should they start right away? Consider that they may still be working full-time and also collecting Social Security at age 70, for example. In other words, Medicare IRMAA will likely explode, as well as 85% taxable on Social Security benefits. What to do? So that's a lot.
So with the Secure Act 2.0, the RMD age has moved from 72 to 73, and that's for people turning 72 this year. So it gives them an extension of 1 year to take their RMD. And typically, we recommend that if you can afford to hold off on taking an RMD, then you should. Obviously, that's a case-by-case basis. But the longer you can delay to take those RMDs, typically we say that's better to keep the money invested. One thing that does do as well is it extends, gives you another year that you can do a Roth conversion without having to take an RMD in addition to a Roth conversion, because any money you convert to a Roth does not count towards your RMD. So it does give you an additional opportunity to do that. But so with Social Security and an RMD, we say as long as you can afford to, generally speaking, it's good to hold off on taking the RMD.
Okay, it's good. Also, always a case by case, but that's a good summary. Chris, this question's for you. How bad can a debt ceiling crisis affect our economy? That seems to be the big topic now.
No, it's certainly come up a number of times. As in St. Pete and Sarasota last week for a couple client events, and that was certainly on folks' mind then. And I think it's important to distinguish what may be some short-term volatility and fireworks that could emerge in the markets around some political grandstanding, shall we say, or just inability to come to a compromise, which could create volatility with more of a longer term impact. And I think there I'm brought back to one of my favorite quotes, sort of on the economy and politics from the 90s, from the political strategist James Carville, who was said once, if he could be reincarnated as anything, he'd come back as the bond market, because you can intimidate everyone. And I think you could broaden that to I'd come back as the capital markets. Speak in the political will to create significant pain in the capital markets generally is not that strong. And so just as we saw back in 2009 when the first vote on the Troubled Asset Relief Program, or TARP, failed, Congress very quickly came back I think it was the following day actually to pass it, given the rather stern signal the market gave them, voicing its displeasure. So, for us, we think that they will, they ultimately find a way to get it done. There may be some more volatility in the meantime, and a lot of noise around it. And so, from our perspective, with our investment approach, we know the companies that we want to own and the prices that we want to own them at. And these are based on the underlying fundamentals and business prospects for these companies longer term. So if something like this gives us an opportunity to add, or in some cases increase, we're going to look to do that, as opposed to trying to on the front end forecast will they or won't they come to an agreement sooner rather than later.
Okay. The next question, this, just like the debt ceiling, we have to cover inflation. That comes up all the time. It's in the paper, it's in the news every night. Chris, what's our outlook for inflation?
So expectation is broadly to see the headline numbers continue to track lower. In particular, a lot of the surge in inflation that we've seen has come from the good side, or some of the more volatile components. Think new cars, used cars, even fuel, gasoline, and the like, airfares, things like that. And so a lot of those, as that demand spike that happened as the economy reopened and folks were flush with government stimulus money, that's fading, and we're seeing now lots of stories of excess inventory and in sales in certain areas. So we think that will likely continue to bring down the headline numbers with it. On the other hand, at the moment, the base case is sort of longer term is probably an inflation rate that is structurally higher than that we'll call it 2% that we enjoyed for the past decade, and that is due to a whole number of reasons, from particularly on the services side, right? We think about demographics and the continued aging of the the baby boomers, and shrinking a key portion of the workforce there, and the structural shortage that we've had of workers, particularly skilled trades. All this puts a bid under wages. Additionally, that trend I had mentioned of probably less full stop globalization and more regional trade, and so we're giving up some of those competitive advantages to global trade, and likely incrementally higher prices. But we do think as we look forward that headline number is likely to continue moving lower.
All right, Megan, I'm going to let you handle the live questions. Otherwise, I'll freeze my screen.
Okay, the first question is for Chris. And we had someone ask about how interest rates are impacting real estate valuations.
Sure. And so I think this was in response to the fact that we had called out real estate as one of the themes that we have identified, or that we hold in our portfolios. And I think that's a great point. And there is certainly for real estate writ large, when we take up the price of money, assets that are largely debt financed certainly feel the pinch. But within the direct holdings that we have in our blended portfolios, we've focused on themes, data centers and communication infrastructure. So areas where we see more growth that can, even despite some of the cyclicality in the economy and some of the headline, the pressure from rising rates, we think those businesses remain well positioned. But I think it's an important point to make. And related to that, though, is there will likely come a time where we actually want more real estate, as we see we experience that pain of higher interest rates on real estate valuation. As that cycles through and we see an opportunity, that's likely going to be the environment precisely when we'd actually want to add to more broadly to real estate in portfolios, with the idea that as conditions moderate, companies would be able to benefit both from the tailwind of perhaps lower interest rate pressure, as well as a revaluation as conditions improve.
Thanks, Chris. So I know we're running short on time here. So in respect of everyone's time, I know it's getting late. That's all we have for today. I know there are I see two more questions that we will follow up on. And you should also be receiving a survey at the end of this. We welcome and appreciate your feedback. And thank you everyone for joining us today.